said all throughout, late March into April, gold is sending a warning. Right. And I thought the warning was around Japan yen. And then I said, well, maybe it's war. And then you had this, fear for a moment in time of World War III.
What's going on, Michael?
Just another day of me not eating, fast.
Are you feeling okay? Gonna get through this?
Oh, yeah. Listen, I mean, I think when you have a large social media following, you want to have those moments where you can go viral. So if I happen to pass out during this interview, I'll get my chance to do that. No, I feel pretty good. I mean, I'm 50 hours into a fast as we're chatting, so my energy level.
Send me your address so I can call the ambulance.
Yeah, exactly right. If anybody's listening to this, don't worry too much.
So, listen, I thought you had a really good call, and what I mean by good call, not so much of the effect, but a couple of weeks ago, you on a different program, you talked about how the yen carry trade was going to get right in the next, well, right at the moment, if you would, maybe not. I don't mean that in the minutes, but in the days. I want you to talk about it hitting. Well, first of all, let's start with what is the yen carry trade for those who don't know, and you spent a lot of time with that, and why that it's important, and what does it mean that it's hitting?
Yeah, well, I think the process may have started, right? Because we saw clearly the Bank of Japan intervene twice, right, with the yen. Okay, so I know it sounds like a complicated term, but it really is very basic at its core. The carry trade is the idea that because money can go anywhere in the world, investors borrow at very cheap rates from Japan in yen. They then deploy that in other higher yielding securities, whether it's bonds, stocks. So basically, they're playing the spread, right? You're getting capital for free, basically, from Japan, and then trying to earn a higher rate of return somewhere else. So it becomes a source of margin, effectively. Now, the key thing is you're borrowing it in yen, right? You're borrowing it from Japan in yen in their currency. So if you're borrowing in yen and the yen is weakening, you as the borrower actually love that, right? Because you're paying back that loan eventually to whatever entity in Japan with a weaker currency, right? And your currency being stronger, right? With the yen itself being weaker. So it actually helps your return profile, right? The weaker the yen is, relative to your currency, on top of where you're investing it into. Now, the opposite also holds true, meaning when the yen appreciates against your currency, now you as the borrower have a negative return, right? It's actually a headwind against your total return because of the currency conversion if you're unhedged. So the whole carry trade is you borrow from Japan super cheap, you're deploying it elsewhere, but because of the currency movement, the implication of what you do when the yen is weakening or the yen is appreciating will matter on what you're actually leveraging that capital into, right? Which in most cases is risk on, riskier assets.
Okay, so how long has this been going on, and who exactly is it doing it? Is it just big hedge funds? Is it central banks? Who's borrowing the yen, hoping that it depreciates, or not? Hoping is the wrong word. Maybe manipulating that it depreciates, and then, work me through that.
Yeah, no. So I mean, it's everywhere and everyone. You can argue, right? Institutions, hedge funds, including, by the way, investors in Japan deploying it overseas to other capital markets. So it's kind of pervasive, right, across the entire globe. It's hard to get a handle of the exact numbers, but it is clear that this carry trade has been a dynamic for a long time because Japan has had to deal with, this deflationary, disinflationary pressure up until recently, right? With zero to negative rates, right, as their way of combating it. So it is a big driver of global leverage, right, at the margin. There are some papers and studies that would suggest that the reversal of that carry trade was a big driver of the volatility that was seen in the midst of the financial crisis of 2008. And typically when you see these real risk-off periods, the yen appreciates, which is the reversal panic of the carry trade, because again, if you're borrowing in yen and now the yen's going up, you start selling what you're investing that borrowed yen in your currency into, right, to meet those that currency movement. That tends to coincide with VIX spikes, right? So, and that's just quantitative fact. Now, it's going to be interesting how this plays out. I think a lot of people assumed it would be instantaneous. I always said I think it's the start, right, of that process. The Bank of Japan has this really interesting fight now, right? They don't want the yen to get too weak because the weaker the yen gets, the more inflationary it's going to be for Japan. It's more inflationary because they import all of their oil. So oil rises, yen depreciates, oil priced in yen actually goes up faster, right? They import all their oil, that's inflationary. They have to try to abate that somehow, which means they have to support the yen and try to cause it to turn around. But against that, you've got a lot of shorting positioning against the yen, meaning you have a lot of money that's still borrowing from Japan because of the carry trade, because of the interest rate differentials. So it becomes a question of, can the Bank of Japan force a squeeze on the yen? Right. I think they're trying to. Right. And my whole point is that that becomes the catalyst for broader volatility. Again, it clearly hasn't happened. The last 48 hours, talk on Friday here, May 3rd. The last 48 hours, you've had a pretty sizable move on this excitement around the idea that the Fed's not going to raise rates after all. It's the same nonsense, different day as far as the excuse for why the rally. But I do think that the things are still in motion, right? And I will say that I put out this line multiple times: the bears are still in control. And it sounds weird to say that, right? But most money is long only, meaning most of the real big money does not short and does not try to time with cash. So if you're a large institutional money manager and you're worried and you have to be exposed to long only investments, if you're going to be in equities, how do you be bearish while still being long stocks? You lower your risk profile, you lower your beta, right? You go into sectors which are more defensive, like consumer staples, like utilities. Those areas have been outperforming for the last several weeks, right?
Okay.
And I think the point is that where that relates to the reversal of the carry trade is, if there's concern about Japan potentially sparking a crisis, then that big money would prepare for it by doing what they're doing, which is causing our performance in the most defensive sectors of the stock market.
Got it. Okay, so my question is, Japan has been experiencing some sort of deflation, let's say for 30 years, really since really the beginning of my career in investing.
Yep.
Why now? Now they don't want inflation. Why wouldn't they want it? That would be my question, because if they're
Yeah.
getting inflation, wouldn't they want inflation now? And I mean this not in
Yeah.
an Austrian monetary sense, but just in a pragmatic sense.
They want the right inflation, not the bad inflation. The right inflation, you can
Good
argue
answer.
is the wage side, right? They don't want the cost push inflation, which then, erases that, right? Look,
Yeah.
Japan is a high saving economy, right? Like it's a much older demographic, obviously, than a lot of other developed economies. High savings rates. They they they've always wanted inflation. Listen, why does the government want inflation? Because it makes their debt load less after inflation. But if that debt load is less after inflation against commodity prices which are rising, and that being the source of the inflation outpacing your wage increases, which what taxes are based off of, it's a
Right.
problem, right? And it does create societal discontent.
Yeah, no, I absolutely. If you're 60 years old and you have a bunch of money in the bank and that's depreciating, you're not going to be very happy. And then you're going to tell your children and they're not going to be very happy. Um,
Yeah.
okay. Yeah, go ahead.
No, I was gonna say it's not me trying to be some kind of doomsayer or a perma bear, right? It's like this is a scenario which I think is plausible, that you can spark this domino effect where this reverse carry trade takes place. I could be totally wrong, and if I'm totally wrong, then the next play, if I'm wrong, meaning if you're gonna ultimately go higher and you don't have any real risk off setup, the next play would probably be uh, anything international anyway, right? Because there's this other dynamic that's starting to take place whereby you look at China the last
Mm.
several days, and I've written about this, several times at the Lead Lag Report. There are some interesting signs of hope that China markets could suddenly do well after being in the doldrums for a long time. So my point is that, like, it's a complicated dynamic. I'm still very much in the camp that a credit event is still likely, that Japan is the catalyst. I've said that since August. But you have to also look at the other side of it. What if it doesn't happen? Well, if it doesn't happen, then the real play probably is anything outside the U.S.
Okay. Uh, my head is somewhat spinning.
Yeah, it's mine too because of the fasting.
Well, there's so many implications in here. So how does this tie in then? Because if this unwinds and it just seems like there's going to be if there's not already, there's a currency war. Because then the
Yeah.
ECB just came out just, was it 2 days ago? They talked about lowering rates. They're very dovish. And then Powell came out, so was it Wednesday? Just dovish talk. But again, he's been talking dovish, and then somebody else will talk hawkish the next day. So I don't put a whole lot of stock into that. But I guess what I'm saying, it seems like all of central banks, pardon my language, but they're screwed.
Of course they are. We all are. Look, you can bleep this out, right? I'm sure.
No, go ahead. Go ahead.
You
Let it
know,
rip.
like I have this thing where it's like I say it in a loud, I think in a funny way when I say everything's fucked. We're fucked. I keep using it because again it's persona on X. But it's like, how do you not think otherwise? Okay, so look, this is such a weird last several years. Okay, it feels like we've all been making a ton of money, right? Look at where the in quotes market is. Okay, the S&P 500 on an after inflation adjusted basis is not at the 2021 peak. I mean, I'm sorry, but like,
Right.
really, like after all this, right, of a move, and this is just facts, right? CPI is also understated, so it's probably even worse than. You look at small caps, worse than that. Emerging markets, worse than. So it's like we're all being deceived by a narrative, which inflation is beneath the surface, kind of robbing us of the truth, right?
Right.
So yeah, they are all screwed because you just went through you went through this incredible series of big events which are still all playing out in terms of lags. So you had the shutdown from COVID. There's a lag from that. Then you had the
Right.
reopening from COVID. There's a lag from that. Then you had the stimulus from the reopening. There's a lag from that. Oh, and then you have the fastest rate hike cycle in history. There's a lag from that. So it's like all this has happened in the span of 3.5, 4 years. Okay, well, 3.5, 4 years in the context of market history is nothing.
Right.
But it explains why things are so screwy and why nobody has a clue what tomorrow is going to bring. So we go from the Fed's going to cut rates 6 times in November, December to the Fed's not going to cut rates. They may even hike rates. Oh, but wait, no, they may actually still cut rates. Like, how can you say things aren't fucked when you have
Right.
this kind of volatility in policy?
Yeah. Okay. So on all of that, which I find interesting, and I mean, for full disclosure, I'm quite the believer in gold and precious metals, but it seems, I say that because it seems like this relative strength to gold and now silver has been really like nothing I've seen. Well, probably since 2007, 2008. I mean, it is very firm, and it shows, I think, that there's many really big buyers out there,
Yeah.
because yeah, talk about comment on that.
No, and look, I said all throughout, late March into April, gold is sending a warning, right? And I thought the warning was around Japan yen, and then I said, well, maybe it's war, and then you had this, fear for a moment in time of World War III or 4 or 5. I don't even know what number we're at now on this World War
Right.
dynamics, right? And by the way, it's like, okay, it's easy to say with hindsight, no, nothing was going to ever happen. But in the moment, every time you had one of those strikes happen, the futures reacted so violently, right? And I think gold was sensing that. So okay, fine. In a lot of ways, obviously, good the outcome of actual war didn't happen, or at least hasn't happened yet. But clearly, gold was moving off of some fear. And I keep going back to the idea that gold is one of the true long only diversifiers that's not correlated, right? So let's go back to the earlier point about the bears are in control. The big money is long only. If you're bearish and long only, and you can do more than just go into defensive sectors like utilities and consumer staples to lower your exposure to beta, you go into gold, right? Because it doesn't correlate, right? Which I think is where a lot of the demand has come from. So I think gold. Now this is also interesting in terms of just this kind of manic move that's happened, the last 48 hours. We've had this pretty sizable run, particularly in China, but obviously filtered through the U.S. markets. Gold hasn't really sold off in a big way.
Right.
In the same way the utilities have not underperformed in a big way, in the same way consumer staples have not underperformed in a big way. My point is that I think that gold can keep on running because I think big money wants it to, because big money is still nervous about something, and I still think that something is the yen reverse carry trade playing out. But um, keep in mind, gold has done nothing for what, 12, 13 years prior to this
Yeah.
breakout. Like this is
Yeah.
nothing. This is absolutely nothing. There's a lot of room you can argue for that to keep moving higher.
Yeah. Okay. So let's talk about, we talk about the young carry trade, and let's divorce that for a second. Let's talk about the banking system, because you've seen, you've seen, I don't understand how banks are solvent right now with the yield curve the way it is.
Yeah.
Right. So I think we just had a first bank blow up of the year. I don't want, maybe that's not the first, but the first big bank blow up was that first.
Well,
Big blow?
it's Friday. They may announce something while we're talking. I mean, they always do it Fridays, if you notice. It's always on Fridays on the announcement. Always definitely close on Friday.
It's 4:30, so it might be hitting.
Yeah, we might find something soon. Yeah.
But yeah, tell me about the banking sector. What do you expect in that? And I just, again, it's beyond me why we haven't had more, and that could be the big event.
Yeah, maybe. Listen, I think it's true that if, especially in 2022, if you actually mark to market the banks, they would have been insolvent, right?
Right.
It's, if you actually had real time pricing of their collateral, right? Just like in 2008, that was I forget whatever the FASB rule was, that when they made mark to market and they said this is, you're going to break the entire system that way because you don't want to provide too much transparency around collateral, which is looking horrible against your leverage, which causes collateral fall. I don't know. I think there's an argument to be made that regional banks are probably near the bottom on a relative basis, right? Like I'm much more worried, candidly, about the tech sector than I am about regional banks, right? Because the tech sector's done extraordinarily well, regional banks have done
Right.
extraordinarily poorly, right? So it's like it's a mean reversion argument, and I'd say that's confirmed by what seems to maybe be the start of a rotation finally away from growth into value, right?
Okay.
Meaning if you look at the relationship of the two, and growth is tech, value is more financials, industrials. Um, so I don't know. It's hard to tell. Part of the reason why small caps have still not made 2021 highs is because regional banks have not made 2021 highs. Like the real divergence between large caps and small caps happened in March of last year. And that's when the regional banks started getting to the headlines, right?
Right.
And you had that kind of momentary risk off period. Um, that's not me suggesting to buy regional banks. What I'm suggesting is that if you wanted to be contrarian, maybe if you want to do like a pair, right? You short tech, you go long regional banks, which like
Sure.
nobody in their mind would do, which is probably why it works.
Yeah. And also, too, you could go with the theory that, and I think it's a very good theory, that the banks will be bailed out. So,
Yeah, of course they will, and they're not going to save the equity over the equity holders. They
yeah,
always take the equity down to zero to save the bond
the
holders.
bondholders.
Yeah, that's always going to be the case.
Okay. So, what, I guess the thing is, what was my question? Um, this is fascinating, by the way, but the question is really, I think, what do we do with the bond market? So, if you want to get defensive, is it a good play to buy the short end of the curve?
Yeah, or well, I mean, I think
For
it's
fun, right?
look. I'm biased in that I think it's the long end of the curve because I think there's going to be a disinflation deflation scare if I'm right about this carry trade.
Okay.
But I guess the question is, it goes back to what bonds, right? Like I'm actually very bearish on bonds, which
Yeah.
is funny because people don't seem to understand the difference between treasuries and corporate credit. Right? I'm
Right.
bearish on corporate credit because credit spreads are so abnormally tight. Right? By the way, they were starting to rise. Right? Which is consistent with the yen, intervention. I mean,
Right.
it's starting to play out again. It got whack-a-mole, at least for now.
Mhm.
But again, I still think the process is there. But yeah, I think treasuries will make sense. And actually, this is a good example. Even this recent period, if you look at treasuries duration-wise, long duration against the S&P, it's performed in line with each other. So if you were bearish and short, you lost money. If you were bear, or I think maybe a tiny bit. If you were bearish and used treasuries, you actually had a better investor experience because the volatility of treasury was not as severe as shorting on this loss the last 48 hours. So yeah, I think it makes some sense. If the Fed is worried about Japan, which they could be, right, then they will cut rates in advance of volatility. that they think is coming, which means either side of the duration end probably works.
Right. Okay. So it goes back to, I guess, it goes back to your short-term deflationist. Is that correct?
Well, I think I don't think you can get back to 2% inflation
Correct.
unless you have a credit event, unless you have a shock. And a credit event, a shock, a VIX spike, it's all the same thing, is basically a deflation scare for a moment in time,
Right.
right? Now, this is the other thing I've kind of brought up, this idea that I suspect the inflation source or the concerns around reacceleration are driven by the wealth effect. That it's not supply chain driven, it's not consumer driven. It's more because of stocks and housing. And the two are related because when your
Right.
stock market portfolio is doing well, right? You're like, oh, I don't care about that mortgage rates are 7.5% because Nvidia is going to pay for that interest expense increase. Right. Like there's a connection there between your
Sure.
liquid portfolio and then the housing side, the shelter side, which is sticky on the inflation end, despite some new supply coming on. So, and if you're going to have equities go down, that's going to be disinflationary. That's a reverse wealth effect. So I think there's going to be one of those deflation scares. Now, I've said that for the last year and I've been wrong, right? I
Right.
mean, I always go back to path matters more than prediction. But I don't see how you get out of a duration crisis with it being a duration crisis alone without there being some credit crisis, which is a deflationary.
Okay. I would agree, but here's the fly in the ointment, if you would. Okay. And talk about this. It's an election year. And then what if the Fed just hyperdrives into quantitative easing, bind up all the bonds, if you would, pretty massive amounts of money.
Mhm.
So
money-
yeah, the
the-
stock
the-
market on up, down
Yeah, no.
100 grand.
Yeah, sure. Why not? I mean, but look, if that's the case, okay, but let's hold on, but let's play that out because I think it goes back to my other point. You're actually just hitting on that scenario, which is you avoid a credit crisis.
Right.
And it goes back to what I said. So what's the implication? The dollar should reverse,
Yeah.
weaken, right? What I said earlier should hold true, which is now it gets to be interesting maybe for rotation from growth to value, and which means from US to international.
Right.
International has more value, emerging markets, developed. So those equities then would outpace, right?
Right.
And it would still, I think, break tech dominance as far as being the only sector to really play
Okay.
and help financial. So my point is like everything you're saying is like, yeah, that's a likely scenario. If it's a likely scenario, I'd argue I think it's far more likely you have a credit event than not. But let's say exactly what you're saying is what actually ends up happening. There's a lot of opportunity to play catch up in things outside of the US that would benefit from that.
Right. I got you. Okay. So you're also on the record as saying, though, that is not what I just said is not the likely scenario, meaning that the Fed will save the bond market or they will save equities.
Yeah.
Why?
Yeah. Well, so and this is just based on the pure historical fact of it. If you have a situation where yields are skyrocketing again, the reality is not only is that going to be disruptive for capital markets, but what causes yields historically to drop hard? A hard drop, a stock market that's dropping hard. So you look at the top 1% of declines historically for the S&P 500 going back to 1961. Those real big declines for stocks, yields drop. They drop, and the treasuries get bid up in extreme declines. This is just facts, right? It's not my opinion. It's just like I have the data proving that.
I've lived through it.
Yeah, no, it's outright fact. Which again is why we haven't had the flight to safety because you haven't had that real sudden sharp drop, right, to cause that fear on default risk that causes the flight to safety of treasuries. So
You'll
it's
see
like
yields go to zero real quick.
yeah, well, yeah. I mean, look, you're not going to go back to that. Although if you do go back to that, then I'd argue we're all screwed beyond comprehension because it's like every time we have a crisis, we leverage up even more. So it's like at some point it does become the debt trap of Japan, right? In which case it's no problem. So it is possible. Look, and that would be that'd be a great thing for commodity investors as well. Probably for anything that anyone that's trying to beat the S&P 500, that becomes a much easier risk on environment to play with. I just don't think it's likely, and I again my concerns relate to the lagged effects of what we went through with Fed policy. And it's being most acutely felt in the currency side, which is where Japan comes into play.
Got it. Okay. So the lag effect now with the Fed being very aggressive in raising their rates, that's
You're still in the window.
What's that?
You're still in the window, right, of that
Yeah,
lag. It's like people forgot
that's
that.
what I'm saying right there. That is your thesis, really, is
Yeah.
meaning we still haven't experienced because everybody was talking about if the Fed keeps on raising rates, things are going to break. They haven't broken. We're still in the lag effect. Well, it's coming. That's the
It's
thesis.
it's li the condition would suggest it's likely to come. But again, maybe they did pull it off, right? And maybe
Yeah.
I'm just an old man old man old man and yelling at the clouds, right? That's fasting, right? And trying to do hoping for mana and food to come into my mouth from the clouds. But, like, the point is, like, this is about probabilities, right?
Mhm.
The Fed really has never really properly done a soft landing, right?
Yeah.
And I don't know why people are gravitate so strongly to that narrative. Just look, we're in May now, right? In the span of 7 months, we went from 6 cuts to possibly hiking rates to go cutting maybe once or twice. Like, give me a break. This is in 7 months. How can anybody have any confidence in anything like
Right.
this?
Yeah. Okay. So, what is, again, you give me the probabilities and what you think is going to happen. Give me like what is likely. Again, are we going to have a major sell off again? And I'm not saying this to
No,
say get you hung by your own words, but
I
I
think
do
that
think we will have a major sell off by the end of the year, by the way. But yeah, what is your by the end of the year?
again,
What's your likely scenario?
look, it's always a question of when, right?
Yeah.
And that's the thing. I always go back to you can be bullish and bearish at the same time, depending on time frame, right? I am bearish in the short term because I think the process has started with Japan.
Yeah.
I don't know what exact day or week or month. Like,
Of
I
course.
think the process has started, right? And I think you'd be hard pressed. Like, if next week suddenly the yen gives back a good amount of the gains following the Bank of Japan's intervention, there's going to be panic. Right? I mean, I don't see how you couldn't have panic. So, okay, so scenario one is tail event, credit crisis, credit event, Japan's the spark, which has always been my base case. Scenario two is you don't have that, in which case there is a hell of a move that's coming for emerging markets, for the value style, and tech will be the laggard in that scenario, right?
Got it.
Both are can be very good as long as you can get ahead of it, right? Or try to get at least a good chunk of it. I just think that, and by the way, I'm not suggesting that with crisis things stay down like at all. Like some
Right.
people think I'm just like suggesting, oh, credit event, and that's the end of the world apocalypse. It's not apocalypse. It's just a
Right.
big spike. That's all I'm talking about. We were actually pretty close to one of those again up until this week. It
Yeah.
might assert.
Yeah. Okay. So what's the next thing I guess that you would tell people to look out for um that would push this over the edge?
Yeah, it would be oil, right? Because the whole thing that drives this situation with Japan
That
is
is an interesting answer. Go ahead. I don't
yeah,
mean to
no,
interrupt you.
no, because it's really bad. I put that post out on X. I said, this is not so much about the yen; it's about oil, right? Because it's
Mm.
the whole thesis was always it's about oil priced in yen. So let's say oil drops substantially. Okay, even if the yen keeps on depreciating, it's still going to be okay for Japan then, right? Because oil is losing, so the imports become cheaper, even though the currency is still weakening. As long as the pace of the weakness doesn't outpace the weakness in oil, right? So, okay, so that could be a positive if oil breaks. If oil were to rise aggressively, which was my concern when all these, the Iran Israel dynamics were playing out with the back and forth strikes. I said, yeah, I put this like list on X. You have war, oil spikes in yen, that sparks the reverse carry trade. Like if oil were to spike here, and Bank Japan is only now just starting to try to counter the yen weakness, that furthers even to me, it makes it even more likely that you're going to have that reverse carry trade scare, right? So I really do think oil actually is a big. What happens to oil is going to determine what happens with Japan. I think it's kind of the point.
Wow. But there's so many implications to that, like just political, geopolitical implications. And then also, I mean, really, that's what I would say. And it's kind of interesting because I think the price of oil where it's at now, with everything going on in all the world, really supports your thesis, I guess, of deflation. Because why isn't oil over $100 a barrel with everything going on, with all the risk going on now? There has to be massive deflation,
Well,
right?
it is true that oil tends to weaken in advance of recessions, and it spikes and then weakens in advance of recession. It's just unclear. I think the point is that if you're trying to look at this from the perspective of buying time, oil is what does that, right? That really is the key to this.
Interesting. Okay. Well, Michael, I don't want to take up any more of your time, but I want to thank you so much for coming on. If people, which you don't need any introductions, I'd love for you to give your how people can reach out to you and find you.
I appreciate that. At Lee Lagerport on X, YouTube, leelagerport.substack.com. I do my best to try to. I have a persona on X on social media, but I do my best to try to think differently. And like this is not straightforward or easy. I think a lot of people are getting sucked into these narratives, not really understanding just how big the risks are beneath the surface. And I'm not saying that as somebody who's like a perma bear by any means. Again, I don't believe in short. You can be bearish and still long, right? And gold it clearly proves you can make money while being bearish and wrong about your bearish thesis in the short term. Same thing with utilities. But hopefully it's at least providing some people a different way of thinking about things, because if everybody's thinking the same way, nobody's thinking.
That's right. Well, it certainly has done that for me. I will make sure I link to everything in the show notes, both on the YouTube channel and in the podcast. And I can't thank you enough. And Michael, you're very gracious to me and very responsive. And I apologize about 2 weeks ago when my power went
No,
out.
you're good. No, I appreciate it.
All right. Thanks a lot, man.
Thank you.